Welcome to the It's Your Smarter Money Show, where you will learn well to live well. Discover investing and financial planning strategies, ways to live your best life, insights from engaging experts, and much more. Now, please welcome your hosts.
While uncertainties are encircling all around us between the tariff talks, the big beautiful bill, and all the other noise, it's important for us to recognize that markets tend to be volatile. And if you're not paying attention, maybe you haven't noticed, but the markets move any 5-year period, 10-year period, 20-year period, we see lots of volatility. So it should not be coming as a surprise that we have volatility. And now we do have a lot of volatility currently and probably will be for some time. And we could sit here and talk to you about our thoughts around the tariffs and the taxes and all those other things. We think it's much more productive for us to talk about our perspective around the markets, around volatility, and how you can protect yourself. So that's what we'd like to do today.
Yeah, and some of the historical volatility and inter-year declines, which we show
right
here. Yep.
Right. One of the things that I found very interesting, Steve, when I was looking at this chart, that we have not had 1 year since 1980. So we're talking about 25 years where we haven't had any inter-year decline. Every year we've had some declines, some of them large. If you look at 1987, it's down 34% during the year, but we ended up that year by 2%.
That's right. And so you can't really predict what's going to end up happening for the year based on an inter-year decline. And it's also important to know that the last 2 years for the market were very, very, very strong. I guess you have here 24% for 2023 and 23% for 2024. So it's not always common to have such strong years back to back like that. So the market could be overvalued. We're not sure. Of course, when a market is overvalued, it's potentially more sensitive to shocks, things that create uncertainty, for example, tariffs.
But they were, even those years, they were throughout the year, they were down at one point by 10% in 23.
Yep.
Even in 2020, when the market plummeted by 34%, it's still ended positive 16%.
I think before yesterday, the market was up about 9.5% yesterday, which is actually the third largest increase for the market since World War II in one day, at least.
Right.
It was down about 15%. So we already had a pretty substantial inter-year decline for this year. But you have to always look at it in a longer picture. And obviously, we always have to make sure that the way you're invested is targeted toward your need and that you can withstand the longer picture. So if you're in retirement and you're drawing down part of your portfolio, we're always going to make sure that you have a piece of your portfolio in things that won't necessarily decline, like the stock market does. And in fact, just yesterday, we had a couple clients who needed money from their portfolio. I made sure that we liquidated fixed income so that we don't touch growth assets that could recover, and we want them to recover, obviously.
And this chart shows how many times the market was down in a year by either 5% in yellow, orange is 10%, red is 20%. And yet the market keeps on going. It keeps on moving up. And that's because we continue to be a growing economy. Albeit there are times where it's a slow growing economy and other times where it's faster growing, it's still growing. We still have a lot of innovation, a lot of investment dollars going towards the future. And so our expectation over the long run is that the United States will continue to be a growing economy. We don't necessarily know where it's going to be in the short run, however.
Nope. And there are some good signs on the horizon. First, we had a good jobs report last week. I think there were 100,000 more jobs created than was anticipated. And we had a good inflation report today. Came in around, I think, 2.1%, which was a surprise. They didn't expect it to be that low. So there are some good signs on the horizon. There are always mixed signs in the economy. And some people think we're already in a recession. I don't know that that's really necessarily true. It's hard to tell until you get a lot more data, I think.
Well, the interesting thing about that, Steve, is that I don't know if it even really matters. If you are properly invested for the long term, It doesn't even matter what's going to happen today, tomorrow, or next
Yep.
week. What matters is over the long run. And this really speaks to the idea that when you're investing, it's about time in the market that matters. And so this shows again back to the beginning of 1980 to now, again, the past 25 years, that if you invested $10,000, you would have $1.7 million if you
Yep.
just left it in the S&P 500 and didn't touch it. And that even includes what happened in 2000 to 2010. But if you took it out of the market during any of the best 5 days,
Hmm.
you substantially left money on the table, or the best 10 days, or the best 30 days. And this is what we
Yeah.
see all the time. We see people taking money out, usually at the very worst times. And we want to remind you again that when you're invested, it's a well thought out quality strategy. Your best bet is to not move.
Well, to your point, the market was up 9.5% yesterday. I mean, who expected that, right? And
Right,
so imagine if you'd missed yesterday.
right. Yep.
That's equivalent to 1 year's worth of return. Now, I'm not saying there weren't days, of course, so far this year, the market was down a pretty fair amount, but who knows what day it's going to go down and what day it's going to go up. And so
And
if you miss,
sorry. I was just going to
if
say
you,
on Friday, I'm sure there are people that sold out of their portfolios. Not our
yep,
clients, because
no,
our clients are pretty savvy. I think we're kind of preaching to the choir here. Most of our clients know this, although it never
yep,
hurts to hear it again.
yep, yep. So this chart shows recessions and the recovery of the market after a recession. And typically, when a recession, and we're not saying we're in a recession, but this is just a good thing to see. Typically, recovery is fast and furious right after a recession. If you miss the beginning of that recovery, you'll never recover that potential return. So you don't want to miss the recovery of the market after a recession.
There's a lot of information on here. I think it's
Yeah,
making me kind of overwhelmed. But if you just look at the last box all the way to the right where it talks about the average, and it says
yeah,
the average drawdown in these really bad periods, whether it was back in the early 70s or when it was, is 30.6%. It is possible that your portfolio could go down at any point in time by 30.6%. The worst thing to do at that time, however, is to panic and take money out of the market because, on average, after that decline, this shows that the market pops back by 43.8% in the first year. And so if you're
yep,
sitting on the sidelines saying, "Oh, I need to wait and see when it's going to recover," you're going to wind up sitting. We have a client, and I'm not going to mention the person's name or even gender, but they exited the market back in the beginning of 2009. So you can imagine
mm,
they rode it all the way down, and they came to us
yep.
to work with them around 2019, I think, and they said, "I've been sitting here waiting for the right time to re-enter." They just missed that entire fabulous decade where from 2010 to 2020, the market did unbelievably well, the US market,
It
and
did.
they
And
missed
it's
it.
probably the best performing asset class almost over that time period.
Right. So that's very sad. I feel very sad for that client, but we can only do what we can do going forward now. But you can't do that because it pops up, and it
No,
pops up really quick,
it
almost
does.
in a day or a week. It just pops up, and the market looks like it's a smooth ride when you look at a big chart, but it's not that smooth when you look at the
It's choppy.
detail.
Yep.
And so we want to just mention the difference between savings and investing. So I had a journalist contact me, what was this Friday, and they were talking about people that need money now. They need to take money now. Well, what is
Yeah.
money doing in the market? If they needed money now, why
Yep.
is it invested? We have two types of saving vehicles. We have the types that are very safe and are intended to keep your money safeguarded. Maybe you could get a little interest, maybe you don't, but who cares because you need it. So you need it that way. Whereas an investment is the type of vehicle that you would use for the long run. You're not
Yep.
really concerned about in the short run. And so the common feature between these two things is putting money away for something, but it's being very clear in your mind what that money's being put away for.
Yeah, and what it really means is having a smart place to get access to money when the market declines. That's not going to affect your portfolio in the long run because you don't have to sell things at fire sale prices. That's really the key. So it means you should have some cash, you should have some safe bonds, that type of those types of buckets of money.
And everybody should have an emergency fund because that should not come to a surprise that your washing machine broke or your HVAC broke. It's
But
something.
if you need to have your money not outlive your money, you have to have some money that's going to grow at a decent rate and stay ahead of inflation. And the market is always really the best place for that. But not for all of your money. Now, if you're 25 years old and you're not going to touch your money for 40 years, well, probably most of it should be in equities of some type. But if you're 65 years old and you're retiring next year, and you should probably have a couple years worth of your spending needs in things that are pretty liquid and don't exhibit a substantial amount of risk.
And so this is just something that I created in an Excel spreadsheet. It's not indicative of any kind of return that you should expect. It's just simple math. But I created this chart actually for my students years ago because I wanted to show them the effect of compounding and why and how it works. And so
Yeah.
what I showed them, and really if you just want to look at the 2% column and the 8% column, I said, look, if you have $100,000 and you invested in 2% versus 8%, yeah, in the first couple of years, if you invested in an 8% vehicle, something that gets 8%, you will get $6,000 more than you would have gotten if you just put it in a safe investment that just generated a 2% return. However, with that 8% vehicle, you just took on a whole lot of risk and you just exposed your money to the fact that it might not be there for you when you needed it, as opposed to that 2% vehicle where it was going to be there no matter what. It was a sure thing. You needed that money for whatever it was, buying a house or paying for a wedding or whatever, it was there. And so you need to balance the cost benefit of doing this type of thing. And
Yep.
just to show you visually, because this is in a tabular form, I just created these charts right off of that Excel spreadsheet to show you that in the 5 years, the momentum of the compounding effect
Yep.
doesn't really make that much difference. So if you have a short horizon, less than 5 years, you need to really think about, should this be in a more riskier portfolio or should this be in a safer portfolio? If you
Yep.
are shooting for a 10-year or a 20-year or even a 30-year, oh, yes, you can. Then you want to expose your portfolio to more riskier assets because that compounding effect will benefit you over time. You can see how the growth in compounding on the 8% vehicle is exponential. And
Non-linear.
right. So understanding that and making sure that you don't have money that you're going to need next year in stocks and mostly equities and things like that. Make sure you're in a diversified portfolio.
Yep.
And for our clients, we've done a lot of that, whether it's been earmarking some money just for emergencies or even doing the whole asset allocation where we have asset classes that have performed more, had more stability, such as our fixed income and some of our other pieces.
Yep. Yep. They've held up well. And even actually our large cap has because we've leaned more toward value than growth. And so our large cap holdings are down less than the S&P as a whole.
Right. I mean, this all goes back again when you're managing a portfolio to that whole concept around modern portfolio theory. I know
Yep.
a lot of clients have seen this chart before, but it's the idea of having two different asset classes that have different patterns of behavior. And so when you use them together, you're smoothing out your return and you're not getting as much of a dip. You're not necessarily reaching the high highs of whichever the asset class is that is the top performer. And
Yep.
you tell us which one that's going to be beforehand, and we can make a choice there. But since we don't know, we're going to go for a combination. And so we know that we're always going to have a smoother ride.
That's right. And what we call downside capture.
And this was just a silly little story that once I was explaining to somebody that some people may have recognized as well. I equated it to being having a booth at a farmer's market and you're just selling sunglasses. And when it's sunny, everything's great. You're selling your sunglasses, but when it rains, nobody buys your sunglasses. So one way of dealing with this is to get rid of half your inventory of sunglasses and to bring in umbrellas. And so now it doesn't matter what the weather is like, you always have something that will help you generate revenue and help you cover the cost of your booth, no matter which place you're at. And so you never have to worry about paying for your booth.
Sun or shine, sun or rain. You're ready for both.
Yeah. And this one too, I find this fascinating because this shows how tricky the math can be, where we ask clients,
Yep.
which would you prefer, A or B? And anybody that just had this data in front of them would say A, of course, at a 12% return. And then when we take off the blinders and we say, yeah, but it does look like A is a little bit more volatile, up a lot in the first year, then down a pretty lot in the second year. Maybe people aren't as sure. So then we compared the two, and then a combination of the two with $100,000 invested in those three strategies, one all A,
Yep.
one all B, and a combination of A and B. And we found that with the investing in the A, okay, fine, we had $111,000 at the end. And investing in a B, we actually had more money with an average return that's lower. And so the math
Yep.
gets a little funky when we take into account the volatility. It's not as clean as it would be, you might think. And then the combination is a much smoother. So any kind of volatility, any kind of gyration, anything that gets in the way from making that a straight line return is going to drag your return down. And
That's right.
so that's why diversification is really so important. It's not just about not putting all your eggs in one basket.
It's simple. The average rate of return and your compounded rate of return are two very different things, and there's always a difference between the two if there's no volatility. But if the greater the amount of volatility, the greater the difference between the average rate of return and what you actually experience, which is the compound rate of return. And as an example, the S&P's average rate of return is around 11% a year, but when you compound it, it's closer to about 8.5 or 8 in the 8% range per year, believe it or not. So it's not as high as people think because of the volatility.
And so one of the things that people think about when they think of opposing asset classes, they'll think of stocks and bonds, and that could be one of the diversifiers, stocks and bonds. Steve and I just did a really good video that if you have a chance to look at it from last month, where we talked about the opportunity around international stocks,
Yeah.
because international stocks are also another not fully correlated asset class with the US stocks. And this just shows you, if we go all the way to the left-hand side, under Canada, you can see the US. This was at the end of March, so it doesn't include the last couple of days in April, but at the end of March, the month return and the year-to-date return were both down. Year-to-date, we were down by 4.6, according to the S&P 500. But if you look over to like more the middle part of the slide and you look at countries like Spain, year to date, they had a positive return of 22%. Norway had a positive return of 20%. Italy,
Amazing.
positive return of 17%. Germany, 15%. And so, yeah,
Yeah.
Steve said some of this could be currency influence, but regardless, the
Doesn't matter.
international exposure
Yep.
helped out our portfolios. Part of the
Doesn't
reason
matter what's currency or
portfolios
not, it
aren't
still
down
helps.
as much.
Yep. It's all that matters that it helps. So, yep.
And then the other thing that Steve was mentioning too earlier on was the fact that we take a value tilt and have been even more tilted towards value as we were looking at the markets last year and the prior year, where they were very overvalued,
Yeah.
especially in those technology, Magnificent Seven, top 10 stocks. We've talked about it many times. I know you guys must be tired of hearing about it, but they were definitely overvalued in so many different ways, whether you're looking at PE
Yeah.
ratios, book ratios, whether you're looking at the Buffett index, whatever way you look at to value a company, they were overvalued. And so these tariffs and all this noise that's happening right now, I don't know if they were fully the catalyst for the
No.
market's correction. The
Right.
market was already in a very precarious situation as it was. All it needed was a little push, and it was going to
That's
go.
it. In fact, that's what I said earlier. When a market's highly richly valued, all it takes is sometimes just a minor economic shock or some surprise in economic data that comes out, and the market can drop a lot. And so, it's probably a lot of it was tariffs, but could be other factors as
Yeah,
well.
but if the market was on more solid footing and it didn't have that rich valuation to it,
Yep.
it would not have suffered as much. It was
No.
really not in a good place to begin with. And
Yeah.
we have been talking about this for a while. We didn't know when. We just knew that at some point there had to be some kind of correction. And so we
Yep.
had moved towards more value. And so you can see large cap value is actually positive as of the end of March year to date. Small cap is still struggling a little, but still the value part is more positive than the growth part. And then when you look at even the international markets, it's the value piece that's really doing so well, both in large cap and small cap.
Yep. Yep.
So again, it's important, really to make sure that you have a strategy. Make sure that you understand your short-term needs and your long-term needs. Make sure that you don't have your short-term money invested in long-term vehicles. Really, really important. And then making sure that your portfolio is allocated in a way that it won't completely ride any one asset class down, especially the US market, which everybody tends to be a little bit more weighted, the US large cap market. Make
Yeah.
sure that you aren't just in the US large cap market, because then you're going to really ride the roller coaster and
Yep.
unfortunately react when you shouldn't react. If you are just in the US large cap market and you're riding that roller coaster, just hold your breath and stay calm and let it eventually find its way. It could take some time. And one of the things actually, Steve, I don't know if you could click back really, really quickly,
Sure.
all the way back to that one slide with the yellow and red. And one of the things I just wanted to point out,
This.
no, all the way back, well, to the almost the beginning,
Oh,
the yellow and red and those bars from 1926.
yes.
Even if the one after this one. Okay. One of the things I wanted to show, and I had lines and I took them out. If you look at from 1999, so I don't know, you may not be able to see my pointer. So I don't know if you could go to the bottom and look at 1999 and see where the data point is, and then walk it over towards 2010. You can see that the
Hmm.
market was flat for, it was actually down for that 10 years.
About 6%. Was down about 6% for the entire 10-year period, believe it or
Right.
not.
And then if
Yep.
you go to around the late 60s and look at the 70s, you can see a
Yep.
whole period of time too, where it was up, down, whatever, but it was flat.
Yep.
And then, of course, during the 30s or the 30s, 40s, you had so we have had some periods where you really have had to hold your breath for a length of time.
Yes.
If you have time, so if you're in your 20s and you have the time to ride out a 10-year flat period, then maybe you could be just in the US stock market. But if you have a shorter time frame where you might be fairly soon taking out required minimum distributions or taking out cash to
Yeah.
supplement your other income, you don't want to necessarily hit one of those periods. They're not unheard of.
No,
They're
they're not.
often, but they're not unheard of. And so I just wanted to mention that's part of the reason why we want to have more of a diversified portfolio, because we don't know what's going to happen in the next 10 years.
We have no idea. Yep.
So again, we're happy with the way our portfolios are holding up because of our tilt towards value, our
Yep.
overall diversification, and our discussions with you to make sure that you don't have your short-term cash too invested in any kind of our long-term holdings. So we're happy with that. Hopefully you are too, but certainly open to having conversations if you want to discuss your portfolio. Thank you for listening to us, and until we see you again. Bye.
Thanks for listening to the It's Your Smarter Money Show. If you found this episode valuable, please like and subscribe to our channel. Until next time, learn well, live well, since, after all, it's your smarter money. Thanks for tuning in, and we'll catch you in the next episode.